You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back once again. Time once again for the Advisor's Option, the premier program out there for asset managers, advisors, looking to maybe learn a little bit more about these crazy things called options. You don't want to ask the guy next to you on the desk. You want to learn on your own schedule, at your leisure. Well, we got you covered here on the Advisor's Option. My name, of course, Mark Longo from the THE optionsinsider.com, as well as from, of course, the network upon which so many of you are mainlining these days. Remember, if options education is your go-to, then, of course, we have great shows on the network. Options Bootcamp, all about options education. Options Playbook Radio, also a great educational program. On hiatus right now, but there are still 200-plus episodes of that one to check out. Of course, the Strategy Block segment for the Option Block and many other great educational elements there. So make sure you're checking out the full network if you're not doing so already. If you like what you hear, throw a few stars, a like, a comment, whatever your platform lets you do out there, because it does help new people continue to discover the content. And of course, if you want to go above and beyond, and who can blame you, the optionsinsider.com/pro. Great pro Q&A sessions coming up, including one coming up a little bit after this show, where we're going to delve deep into the world of volatility. So if that's an area that interests you, or you have other areas where you have questions about the world of options, as well as our Options Oddities program, live access to everything we do, great giveaways, and a whole bunch more. The optionsinsider.com/pro, the place to go to learn more. As we learn who's joining us on the old Advisor's Option program this month, I am pleased to welcome back on, once again, my compatriot in all things Advisor's Option crime, Mr. Matt Amberson, the founder over there at ORATS a.k.a. Options Research and Technology Services, a.k.a. the creator of Otto, the new rogue AI taking the options world by storm. Mr. Matt, welcome back to the show, sir. How go things with Otto? Has he taken over the world yet?
I was watching what they were calling the godfather of AI, and he's very worried that AI is going to take over. So I might have to just turn the lights out on Otto.
I might have to shut off Otto. Was that the 60 Minutes piece they just did?
I think so, yeah.
I didn't get a chance to watch it, but I heard some clips, and yes, you're right. He was not exactly optimistic. So, yeah, maybe. But now Otto has heard that. You've said that, so he might be coming for you as we speak during the episode. So watch your back. Watch your back as we keep on rolling throughout the episode. And also joining us today to discuss all things advisors and options, including a very fun strategy that may be in his wheelhouse, pun intended. He is the uncleist of Mike's, Mr. Uncle Mike TOSAW from St. Charles Wealth Management. Uncle Mike, welcome back to the Advisor's Option, sir. It has been too long.
It has. It's always a pleasure to come here on the advisor side of the show.
All right, and let's get going, listeners. A little bit of the old P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, welcome to the P&L statement, the segment that was born out of the pandemic because so many insane things kept happening in the market, in the world of volatility, and just the options world in general since and indeed between our episodes that we thought we need to spend some time at the top of every episode breaking it all down. Hence, the P&L statement was born. And since the last time we gathered here together on the show, listeners, it's been a tumultuous period for the market. We were seeing a lot of green on the screens. Then Powell and company came along and kind of cut the legs out from under the market, kind of maybe put the lie to a little bit of the maybe rate hikes being moved out into the distance a bit, maybe even a cut sometime next year. People, after listening to Powell, kind of thought the better of that, a little bit more hawkish than perhaps some people were expecting. That kind of cut the legs out of the market for a bit. We saw a lot of red on the screen, vol popping a bit. As we came into end of last week, beginning of this week, we started to see that vol relax and the markets continue rallying, even with the somewhat startling events playing out over the weekend in the Middle East. We still didn't really see a big sell-off, a little bit of a sell-off coming into the start of the week, but that was really about it. It's been mostly green on the screen ever since then, and vol continuing to come back in. As we're kicking off the old show here, we're seeing the S&P right now, listeners, back north of the 4,300. In fact, back north of 43.5, 43.65. So nice little rally out there again today. And after popping back into a 20 handle last week, VIX now back below a 17 handle, about 16 2/3 out there right now. So kind of hanging out right in the middle of the teens right now, listeners. So an intriguing time. Mr. Uncle Mike, we will start with you, sir, as our guest. What is catching your eye out there in the broad markets from a valuation perspective, as well as from a pure vol perspective right now, sir?
Well, in terms of the broad markets, the first thing that's catching my eye right now is actually bonds. We had a Columbus Day rally, so to speak, yesterday in the bond market. And so you always wonder, is that something to where it's low volume? Is it going to hold up? Is it going to continue? And, as so far today, the rally is held from yesterday. Now, we did sell off early in the morning today, but as of right now, we're still in a spot to where we're fairly close. I mean, we're down slightly on the day today, but we had a nice pop yesterday in the bond market in the 10-year. And so far it's holding. And so it's going to be interesting to see if it continues to hold. But we'll see where we're at with that. Other things that are catching my eye in terms of the S&P, we are back. We're knocking on the door of 4,400 again. And we've just been in a rally ho mode pretty much since last Friday. And so we were wondering, I know on the Option Block, our other show, great network, by the way, we were talking about if we were going to hold the 4,200 level last time we talked on that show. And we did. And now we're knocking on the door of 4,400. So we've had quite the rally in the markets. And so it does make you look at it, and we were selling off going into over the course of the last couple of weeks. We've been kind of channeling, but we're at the lower end of the channel, if you will, or even below the lower end of the channel last week. And then with the bad news that's happening in Israel, which I don't think is going to end anytime soon, it's actually very concerning on a variety of levels. But with that, markets have rallied on that. So somehow a lot of times the market seems to be able to predict the future in a lot of ways, and this may have been one of those ways. And then the old adage, buy on bad news. And with what's happening in Israel, I can't think of much worse news than that, with the exception of it happening in our homeland in the United States. But it's very bad news. But the market seems to rally off of the bad news, if you will, from where it's happening on that. The other thing of note is that with what's happening in Israel, we are looking at, let me just switch my charts here, and looking at the precious metals, we've actually rallied a little bit along those lines, like with silver, for example, looking at SLV, we're up 5% on that over the last few days. That's really not that big of a deal for silver with the volatility of it. So we got to keep that in mind with where we're at and what we're doing on it. And then in terms of what you would always want to look at whenever we have any type of conflict in the Middle East, that's the energy stocks. Where are we at with those? And then in looking at XLE, that's one that's also been a little bit of a rally mode, so to speak, but it's kind of bouncing off the bottom. So in terms of what's lighting up my tape, just monitoring that situation fairly closely. I normally don't like looking at the political news channels, so to speak, but you kind of have to if you want to get the news on what's happening overseas. And so watching that and just hoping and praying that this can end quickly, but unfortunately, I don't think it will. So that's what's lighting up my tape right now.
Yeah, I don't think anyone said coming into this weekend, what the world could use is some more tanks rolling. That's just what we all need out there right now. Yet that's what we're all living in. It's really why this segment was created, listeners. These things pop off pretty much seemingly between every episode, it seems like, these days. So we need a place to discuss it here at the top of the show. Let's go out to Matt now. It's kind of nice having Mike and you on the show this week, Matt, because Mike's always been kind of our resident ray of sunshine, our resident permabull, our resident optimist. And not to say that you aren't optimistic, Matt, but I know of late you've been on and really hitting hard for that 3,000 before 5,000 tip. So you're, shall we say, a little bit more on the bearish side. What are your thoughts on what we're seeing out there, coming into Powell, then post-Powell now, what we've seen, kind of the market getting the legs cut out from under them, and then all of a sudden in the middle of last week till now, really, and including the weekend, which shocked a lot of people, the market kind of rallying past all of this and vol kind of going back in the other direction yet again, sir.
Yeah. Well, it's, I don't know if you'd call it a head scratcher, but, the futures were down about almost 1% over the weekend, hearing about what's happening in Israel. And then to rally that far, I mean, that's that is amazing. And, a lot of money was printed. So again, we're back to spending is out of control in Washington. The Fed is out of control, printing money, trying to protect the markets. It's going to come home to roost. I don't know if you heard Rick Santelli with his 13.5 interest rate long-term prediction, but I think inflation, they're going to have a very difficult time controlling it, especially with all that's going on out there. And so it's just going to be a long-term inflation. They won't be able to cut interest rates responsibly. They'll print money. I just don't see how they're going to get out of it. Housing is already starting to crash. Austin, Texas is going first. They're way overvalued. San Francisco is coming down. There's just so much out there that is getting close to breaking. And but I think the market kind of had a relief rally that, it's somewhat contained in Israel. If it's hard to say that, but it's so brutal what's coming out of there. But I hate to say this, but even cooler heads are kind of prevailing a bit. It's always hard to tell what's going on there. There's been such a long history and such, so I'm not even going to try. But yeah, Mike's right. Those things don't really end that quickly. So, but the markets are saying, nothing to see here, no big deal, which is kind of crazy. And we got CPI and PPI no one's talking about. So the funny thing is PPI, so we do these kind of implied moves. PPI is coming out Wednesday morning, CPI Thursday. Thursday's the big day, at least according to our implied moves in the market. So, we'll get some numbers on CPI. I think they're not going to be that good. And I think that might hinder the market a little bit. And then we got earnings coming out. Earnings, how long could they continue? A lot of these bigger stocks are going to be okay. But, these smaller stocks are just in a lot of trouble. It's tough doing business out there. The consumer is just slowing down. I think it's going to come home to roost soon. But the strategy is you have to keep, I have these out of the money put calendars and put verticals for when the market corrects, but you gotta have some longer deltas that are contained near and shorter term to so you don't lose your shirt while you're waiting for the market correct. So that's what I'm seeing, Mark.
A lot to unpack. What are your thoughts on what we're seeing out there right now, listeners, from an overall market valuation and volatility perspective? I'm curious. Hit us up, whether you're listening live, listening on demand after the fact. Send them in and let us know as we keep on rolling into this week's Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101, the portion of the show where we break down an options concept or technique or strategy and explain how you can utilize it in your clients' portfolios. And I had a fun pun at the top of the show when I said today's strategy is indeed in Mike's wheelhouse. But it is, because it is the wheel strategy, the wheel trade. It has many different names, listeners. We called it the Wheel of Death when Matt and I were talking about it. Well, he wasn't down with that time. I was calling it that when we were joking about it a few weeks ago when he joined me on the Options Bootcamp to discuss a little bit of wheel action. But yeah, it is wheel season, it seems like, out there these days, listeners. So it seemed like a great time to explore this strategy on this program as well, because it is so applicable to what so many advisors out there are doing and looking for at the end of the day, looking for a little bit of income, looking for maybe a little bit of capital appreciation, and the wheel tends to nibble at both of those. So I'll get into a more detailed description of it in a second. But first, I want to go around the horn and get everyone's top-level thoughts on the wheel. Do they like it? Do they not like it? And perhaps their views on it. We'll start with you, Uncle Mike. That's one of the reasons you're on here today. You're much beloved, as you call it over there at St. Charles Wealth Management, the triple income strategy. When I say the wheel to you, sir, Mr. Uncle Mike, what leaps to mind? What are your thoughts on this strategy?
Well, it has a place. And so I believe that as a financial advisor, I think as an overall portfolio, it has a place in your portfolio. Oftentimes, I think we get in our business, we as advisors or even Mark, you probably get pegged into this too. You get the question, well, what's better, buying a stock or doing a covered call? And people always want to know, well, what's better? And so I don't know how you answer that question, but my answer is yes. And so that's how I respond to that. And so I believe that covered calls, to some extent, or as I like to refer to it, volatility has a place in your portfolio. I believe volatility is an asset class, and how you want to define volatility as an asset class, that's a longer topic for another day, but I believe the wheel strategy could be part of the volatility asset class. Now, what does it mean to me? The concept of our triple income portfolio, it is the wheel, essentially. We have our own little things that we'll do for it, which I'll talk about in a second. But the concept is step one, XYZ stocks at $55 a share, let's say. We like the stock at $53 a share. So step one, we sell a 53 put on it. Step two, we wait till the stock goes down. We let the put be assigned to us at the 53 level, and the price of it's always 1 penny below the strike price, because we always make things perfect, of course, on the stocks we pick. It never goes against us. It's always perfect, of course. Just kidding, of course. But we get into the stock at 53. We got paid to get into it, so that was step one of the income. We'll do it on a dividend-paying stock. The dividend will pay while we are in the stock, so that's the second part of the income. And while we're in on it, we would then go ahead and sell another covered call on it and then get called away, rinse and repeat. And that's the oversimplified version of what we do. Now, in recent times, a couple things that we have been changing now that we have interest rates again, and now that stock commissions don't exist again, because we have a lot of retail clients that are where stock commissions can be a factor in this. What we've been doing is, instead of making step one, selling the put, what we've been doing is buying the stock and selling an in-the-money covered call, and we've been able to do better doing that. Reason being is that depending on the broker you're at, some of them have release policy if you want to buy treasuries with extra money and just keep a portion of it aside for the short put maintenance. Some do, some don't. What we've found is that it's easier to just simply do the covered call, and that works out better for us with where we are. So we've done step one into doing in-the-money covered calls. Now, the other thing that we'll do with our wheel strategy is that if we are a little bit more bullish on a stock, then what we would do is we would sell a call spread instead of a covered call. Now, the disadvantage, of course, is that you are giving up some of the premium, because a $5 call spread is going to pay less than what just the covered call itself would pay. But the advantage is that if, let's say, you run into a situation like we did during COVID, Apple was a stock that we sold covered calls on the way down, and then it just got to the point where we're talking, and we do this to a lesser extent with a lot of other stocks, but we had a big conversation on Apple back in 2020. We're like, look, we're going to look like a bunch of big schmucks here, because Apple's going to come back at some point. There's not a person on planet Earth, or very few people on planet Earth, that would disagree that Apple's not going to come back. And so what we decided to do was, we've just done this on many levels with many stocks. Sometimes we're right, sometimes we're wrong. Apple was one that we nailed it on. We decided to sell a call spread on Apple. And so Apple just ran right through that call spread, right back up to where it did. And we had a really good year in 2020 because of that. And so that's one way with which we'll use a call spread in lieu of a call. Now, yeah, we lost money on the call spread itself, and we could have just sat on the stock, but we also wanted to be collecting premium, because unfortunately, we don't know the exact day stocks are going to come back. So that's kind of a synopsis of how we run our triple income portfolio. And I think it has a place in your portfolio in terms of the risk. I think it's usually somewhere between stocks and bonds. Now, theoretically, bonds have been going down a lot over the last year and a half because of rising interest rates. So I think it's a good alternative to have within your portfolio. Should you have this as your total portfolio? Absolutely not. But I do think it has a place dependent upon what your risk tolerance is, what are your long-term objectives, what's your tax situation. I think it oftentimes has a place. So that's my take on the wheel.
All right, Mr. Matt, same question for you. We'll get into the nitty-gritty of it in a second, and I know you have some upgrades you like to make as well, but 10,000 foot, just when I ask you about the wheel strategy, what comes to mind, sir?
Well, I don't like ever selling naked puts, and I think saying it's cash secured is a misnomer and misleading. So I don't like that part of it. And for the reasons that Mike just brought up, I don't like selling a naked call against it. So I don't like the traditional wheel strategy, but I like things about it, and if you tweak it a little bit, you can make it work. How's that for a short answer for you, Mark?
There you go. Tweaks to make it work. All right, let's get into the nitty-gritty of it. Mike kind of broke it down for you listeners. I'll do it in a little bit more detail for you in case you're still confused. What is this wheel thing we're talking about? And we're going to start with the traditional basic. Mike already kind of gave you one upgrade, one tweak that you can do to it. But the traditional wheel strategy, you're an advisor, your client, maybe you are interested in XYZ, everyone's favorite name. is trading for around $100 right now. Maybe your client, you're interested in nibbling if it gets back down to $90. And you think it may have a chance of getting there over the next month or so. And in our example, the 90 strike put is trading for $1. So nice round number. How great is that? XYZ. So plentiful, the premium out there. So you can do a couple of things. You can obviously just work a limit order to buy. You want to buy 1,000 shares. So in this case, you work a limit order to buy 1,000 shares for $90. But we've always discussed in the past how you're not really getting compensated for the risk. And working limit orders in stocks is a risk. We've all seen that played out many times over just recent years. Markets can whip around. You can get hit on these orders, and there's nothing coming in to really compensate you for that risk. Or you could turn around the way we talked about many times on this network and sell a put. So you're effectively doing the same thing, but now you're getting a little bit of an income stream to offset that risk. In our case, you're collecting $1. Remember, of course, at the end of the day, you want to do 1,000 shares. So that's 10 contracts. Every contract is for 100 shares. So $1 times 100 shares for the underlying times 10. That's $1,000 in your pocket for the next month to sell that put. Now, again, you know the deal with short puts. I won't belabor it. If the stock expires below that level, you're getting the stock put to you. Otherwise, you keep that $1,000 and you could rinse and repeat as often as you like out there. We won't get into cash secured things. I know that's a divisive term. We won't get into the margin rates, the opportunity costs. We've discussed all that on the network and on this show in the past. So what makes this the wheel? That's just selling a put. What's the big deal? Well, now let's say you get put to you. Now let's say the stock does expire below the 90 strike. You buy the stock now at the effective price of $89. Now what? Now what do? You could own the stock, sit there, of course. You could maybe decide you don't want it after all. You could let it go. Or you could do the other leg of the wheel, which is now you turn around and say, you know what? I'm long 1,000 shares of this XYZ. It's right around the 90 price right now. I wouldn't mind letting it go again if it goes back up to where it was, back at 100. So in our example, once again, the $10 out of the money call, still trading for $1. Nice round number as an XYZ. It's so nice. So you can do the same thing, same math. You collect $1,000, 10 contracts, times 100, times $1. So you're collecting $1,000 at the end of the day to sell 10 of these 100 strike calls now for $1. And same deal. Stock hangs out around here. Nothing really happens. Rinse and repeat. You collect your $1,000 and you could do it again and again ad infinitum. If the stock rallies now and expires above the 100 strike where you sold that call at the end of the month, then of course your stock will be called away at an effective price of $101, which is of course $100 plus the $1 you collected to sell the call. And now you got paid to get in. You got some appreciation on the way out the door, and you got paid to get out. And that is where the wheel comes in full rotation. And now you're washed your hands of that position, and you could decide what you and your clients want to do from there. Maybe you want to try that trade again. Maybe you want to move on to something else. There's a lot of different moving parts to this and a lot of different factors to determine how and when and why you should do this and on what underlyings. But that is the basic overview of the wheel. Now we'll get into some of the fun. Mr. Matt, we'll start with you. We'll go the opposite of the way we went this time. You mentioned before some of your caveats to even setting up the wheel, which I believe you like to look for underlyings that also have a healthy dividend stream along those lines. So maybe we'll start there. What are some of your criteria you use when deciding which names to establish a wheel on? And then, as you said, you don't like the whole notion of selling the put by itself to begin with. You like to make some tweaks. So then let's get into some of your upgrades, perhaps your wheel 201 or 301, sir.
Yeah, and let me just back up one more step, because we've done a large back test on the wheel strategy. And the thing that I learned is it's so important, as Mike was saying, is the timing. Are you going to get it put to you or not put to you? And that's going to make a huge difference on your upside and all that. So the back tests, you have to look at them kind of in mass. You can't look at them at one off, because there is so much difference between owning the stock, getting it put to you, or getting called away for that matter. So we've, if you look on YouTube, we put a new wheel strategy YouTube up, and we go over some of the results, and you could go to our dashboard to check it out. So that's the first thing is it's, there's a lot of kind of luck path dependency to it. So, Yeah. So what kind of stocks? Yeah. So what I'm moving more towards is kind of what Mike was talking about. You want a dividend stock. You want to sell some calls, but not get called away. And you want to have that short put premium coming in as well, but you got to be protected there. So, me, Mark, I'm going to back test some things. And what I've been finding, what I'm doing is finding these high dividend stocks. We have on our orats.com, we have a whole table full of those. And TD came up, AT&T came up, Verizon came up. They're just, very, very nice dividend yields and also very nice premiums. So what I've been doing, instead of selling the naked put, I will sell a put diagonal, where you sell a closer to the money and buy a farther out of the money. So, and you do it for a credit. So you don't get as much of a credit, obviously, but you still have a decent credit coming in. And then if you line up and then I actually put on the stock with a collar, because I don't want to miss the upside, as Mike was talking about. And then I sell I do the same thing for the call, then do a call diagonal. So, and I'll actually put a collar on the stock. So I know it sounds kind of crazy, but this is what I'm doing. And those are all sources of income. So you have a collar on the stock, so that kind of fits your upside and downside. Let's just say it's a zero cost collar, and so you don't lose that much if the stock goes down. Then you sell your put diagonals, sell your call diagonals. So you have those sources, and then you have the dividend source. So those are your three sources, how I like to play it. And, I calculate in TD, for example, that's 14% a year. If it just stays where it is or goes up or goes down, it's a little bit less than that and more than that if it goes up. So, you could do pretty well on these strategies, not get called away, and, be able to participate in the upside. You have a put there for the downside. You have the diagonal to make some extra money without as much risk. So, I like to sleep at night. I was a market maker. I know anything can happen. That's the way I'm playing it. It's a little complicated, but maybe I'll do a video and explain and show some numbers, Mark.
There we go. We're getting into Wheel 301. It starts off very simple, listeners, and as you've just learned, you could tweak it and add upgrades in many different ways to make it as sophisticated, as complicated as you want, and also uniquely crafted to suit your needs and your client's needs at the end of the day. Mr. Uncle Mike, you just heard me break down kind of the basic version. You heard Matt break down his 201, maybe 301 version with some other fun kickers in there. So what are your thoughts on his approach to the wheel? And then also, if you have anything else you want to add in terms of the wheel, underlyings you find are more suitable for them, anything else along those lines you want to leave some of our advisors in the audience right now as they're considering this strategy. Have at it, sir.
Yeah. And first off, I just want to clarify, when I was talking about selling a put, we never sell a naked put, meaning a levered naked put. So like, let's say XYZ stock was at $10 and we were able to get 50 cents for the $10 call on it. We're going to have all $10 in the account. What I was trying to just allude to earlier, and I just want to be totally clear on this, is some brokers will allow you to have maintenance release, meaning that you can keep $6-7 into like a 1 month government treasury. And it does exist, but it's too much of a hassle. So that's why I just wanted to clarify on that. And that's why we're doing the in the money covered calls as step one instead of selling the puts. But we have never done a levered naked put to where, let's say we had $10 in the account. We wouldn't sell 2, 3, or 4 of the $10 puts, so to speak. We would never do that with ours. In terms of some of Matt's tweaks, I think they're very interesting. I think they're very well thought out. He's obviously done a lot of back testing on them. I think they're very good from the standpoint that he's really doing a good job in that strategy of trying to have his cake and eat it too, so to speak, and that it's a lot of monitoring and it's a lot of work to do on his end, but I think it's very good with where he's trying to go with it. It's a much more cautious approach in that if the S&P does go to 3,000, then with where he's at with it, he's going to be fine with it because he has the protection from the collar. He has the diagonal on the put that he's managing actively in a way with which is prepared for a 3,000 drop or a drop to 3,000 in the SPX. So I think with his sentiment, it makes a lot of sense from where he's at with it. So let's roll, wheel, roll.
There we go. Roll, wheel, roll. So there you go, listeners. A bit of an overview of a very classic, on the surface, deceptively simple option strategy that you and your clients can utilize. And again, you don't have to get crazy with it. You can utilize it the way we laid it out right at the top of the show, the very basic wheel, sell the put, or if you're more comfortable, put spread to get into the stock. If the stock gets put to you, you could turn around and sell the covered call to get out of it. You're really just combining two very basic option strategies, just doing them consecutively to get in and get out of an equity position. That's all you really have to do. Of course, we've explored quite a few upgrades here. Mike's version of going with the covered call, which is interesting. I hadn't thought about it that way before, as well as, of course, Matt's way with all the put fun we have going on over there. Before we roll out of the, pun intended, roll out of the wheel segment, Mr. Matt, any other final thoughts you want to leave with our listeners if they're out there maybe considering the wheel for themselves or their clients?
Yeah, I do want my cake and eat it too. That's why I don't get invited to birthday parties. But thanks, Mark. You have to find a dividend stock that has consistent dividends. I mean, not just finding the one that has a high dividend yield. And so you want, so as Mike says, you want the three ways to get paid. You want to get the call premium, the put premium, and the dividend premium, and not lose too much on the stock component. So that's how I go for it, Mark.
All right, listeners, remember, if you have questions, you could listen to this episode again, of course. It's available on demand. Of course, go into our archives. We have touched on the wheel many times. Mike's talked about it in his strategy block segment over there on the Option Block show, as well as, of course, we've touched on it very recently. Matt and I did a deep dive in the wheel on our Options Bootcamp program. There are other attempts at it. We've also discussed it in the archives of Options Bootcamp. I'm sure Brian has on Options Playbook Radio. So the wheel is available for you there in the archives if you want to dive deep. Of course, if you have any questions, you know where to find us as we keep on rolling with the show, listeners, and get a little bit of the old buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everyone, it is time to get the buzz, the portion of the show where we break down some of the biggest option stories or developments that maybe you missed because, hey, we get it. You're busy fielding calls from your clients, as you should be in these very tumultuous times that we are all living in. Let's kick things off here with the story we've been talking about since the beginning of the year, really since the onset of the pandemic. It has been the number one option story development, call it what you will, certainly in the onset of all this madness back in March 2020, which is, of course, what is going on with options volume? Can it possibly continue this explosion, this tsunami, call it what you will, of volume out there? Can this massive influx of new people into the world of options, can it continue? And so far, the answer this year has been a resounding yes. In fact, the last time we did the show, we crunched the numbers for August. August and the dog days of summer, listeners, not known for being a seasonally robust period either for volume or volatility. And yet August blew the doors off. Over 1 billion contracts going up. Pretty much only the second time in history that has ever happened in the options market. The other time, I believe, was March of this year. And it happened in August, a time when everyone's usually on vacation and no one's trading. So crazy times. Could we possibly keep that madness rolling through the month of September? The answer, I should say, is kind of yes, but kind of no as well, because it was still a very robust month. Overall volume, almost 850 million contracts, about 848 million contracts. The ADV also still looking very robust, 44.4 million contracts. Of course, ADV stands for average daily volume, listeners. That's how much paper we're putting up a day out there. That's still blowing the doors off out there. But as you can see, that total volume for September, a little bit below that 1 billion threshold we've come to know and indeed expect out there now, which is crazy just to say out loud that people actually expect 1 billion contracts a month, because not that long before the pandemic, listeners, the whole business, the whole industry did around 3.5 billion contracts in a year. Now we're seeing that 1 billion in a month. It's insane, but that's where we are right now. So how did September stack up to, let's say, September from 2022, listeners? And the answer is lighter, pretty much across the board. Equity options down 7.5%. ETF options down 10.4%. As you mentioned, the total volume down about 7.4%. Even the futures, which are mostly VIX futures that are cleared by OCC, those are even down about 5.3%. The one bright spot, the lone ray of sunshine on the list last month, listeners, was index options. Why is that? Well, of course, we've all been talking about this zero DTE phenomenon that seems like it's lighting the options world on fire. And last month, the zero DTE traders kind of strapped the options world to their backs and said, hey, we'll put up the numbers for you, because index options were up nearly 10% last month in spite of everything else being down. It was about 79.9, almost 80 million contracts going up in the indexes versus about 73 million a year ago. So once again, 0 day making up the lion's share of those gains out there. It's just a juggernaut in and of itself. And that seems to, as the rumors are holding, that the people want to spread it to all sorts of other assets out there. That only bodes well for more volume coming down the pike. So very impressive stuff, even if September not managing to hit that 1B threshold. But again, as we're seeing right now, rallies, some volatility, and then volatility coming off, some shocking events over the weekend. October already seems like it's on pace for a pretty action-packed month. Mike, we'll start with you as our guest, sir. What are your thoughts on the ongoing juggernaut that is the options market? Maybe the surprise we had in August putting up such record numbers, and maybe the subsequent surprise that we couldn't quite match that in September, sir.
Well, I mean, I think the zero DTE, of course, is a big factor in that, because when you're trading something every day, that's obviously going to increase volume. But options are something that, at least for the 20 or so years that I've been in the business, it's been increasing every year, and for good reason, and that people are going to want to customize their portfolios more. There's going to be more of an appetite for hedging, for covered calls, whatever way you want to slice it. And so do I think it can continue? Yes. Do I think it will continue? Well, like anything, we'll have ups and downs and ebbs and flows, but I do believe over the long term, 5 years from now, $1 billion won't be a big deal.
No, on this pace, we'll be averaging $1 billion a month pretty soon. So, yes, interesting times. Mr. Matt, as our resident 3,000 before 5,000 guy, you've also been a little bit bearish on your outlook for options volume over the last year and change. I think you've kind of dialed some of that back of late, because it seems like the options juggernaut is somewhat unstoppable at this point. But then again, this past month, maybe proof that maybe the worm is turning a little bit out there. What are your thoughts on what we saw in September from an overall volume standpoint, sir?
Well, if you think back to last September, the 2022, that market got whacked, and there was a ton of volume. So that's not even that great of a comparison. We're getting at ORAT's getting a lot more users, and the users we're getting are much more sophisticated. Some of them are coming from Option Insider Radio, so that answers that. But there's a lot of programmers too, and there's a lot more systematic strategies. We're building systematic strategies as well. So I think that's kind of leading things. I mean, remember on the market, when we were market makers, we wouldn't do some trades unless we had a certain amount of edge. If you have everything automated, you don't have to earn that much edge. And so, it just creates a lot more volume and, not as much profit, but, some profit. So I think all that together, and the zero DTEs obviously are doing a lot. I think we've talked about this before, but I think that they're not only catching people's imagination, but I think they're very important for the market. You're able to see 1 day volatility. We're implying moves on the CPI and PPI, and saying what's going to move more. And in this case, it's the CPI, but you could do that because you have 1 day expiration. So there's a lot of important things for the economy, for finance, for investors in the zero DTE. And, I think it helps the overall market liquidity. Because it helps market makers balance their books better. So I think all that together has led to, a lot more volume. and better markets out there, more liquidity. We trade a bunch of different stocks. Our clients trade a bunch of different things. I think the market's getting a lot better, Mark. So yeah, it's boding well for the industry.
You are quite the convert to 0-day. Just listen, I think it was Options Bootcamp a few weeks ago, listeners, or maybe it was Options Oddities on the pro side, where you hit that bullseye on your 0-day fly. Just listen to the joy in your voice on that one if listeners want to hear how much of a convert to 0-day Mr. Matt is. Are you a believer in this volume train, listener? You think it can keep rolling, or maybe has the train finally left the station and maybe things are going to slow down? I'm curious. Hit us up. Let us know as we keep on rolling into the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everyone, welcome to the Earnings Volatility Report, another segment that was born out of the pandemic because Matt and I were both just so flabbergasted at how little earnings volatility really mattered for anything anymore. It didn't matter what these names were saying post-pandemic. Vol just came in crashing down across the board. Of course, we have seen that change now. But coming into this year, earnings were still very much a big story, very much a big driver for the market because everyone kept saying, okay, Q1 is when we're going to see the recession start to make its impact felt. Didn't really quite see that in the Q1 announcements. Okay, Q2, cycle for Q2. Here we go. This is where we're going to start seeing it. And didn't really quite see it in Q2. Now here we are coming into the Q3 cycle. The wheel, pun intended, is coming back around again. We're kicking it off. I believe we have financials popping off tomorrow, and then we're right back in it yet again, listeners. So the earnings gift just never stops. The earnings horse can't stop it. It's out of the barn. It's gone out there. It keeps coming back again and again. So if you miss one trade on the earnings front, nice, because there's always another one right down the road here. But Mr. Matt, we'll start with you as the keeper of our earnings data. We now have Q2 cycle pretty much in the can. Any final thoughts there? And then maybe some surprises that kind of came across your radar as you were crunching the numbers. And then B, now that we're ready and set to dive into it yet again for the Q3 cycle, what are you looking forward to there?
Yeah, so I'm looking forward to, what happens in earnings season is, and we saw this in COVID, if it's very volatile out there, it raises the implied volatility of all stocks, and the differential implied volatility addition for earnings stocks tends to not pay for itself. I don't know if I said that clear or not, but in very volatile overall markets, earnings isn't as important, and the straddle owners don't do as well. So, it's now we're kind of in a medium, I'd call it, VIX, falling VIX, but so that might bode well for the earnings season, meaning, when we say bode well, we say, how did the straddle owners do? Because we're always wanting to root for the underdog, Mark. But I think that this season should be a fair assessment. I think, and I've thought this whole year that at some point the earnings, people looking at earnings and looking at the realities out there in the market, in the economy, they're going to be some much worse earnings than I was expecting, but I think that they're still going to come home to roost. So I think that the bigger companies, it isn't as daunting, and so I think weeks 1 and 2 might be kind of not that great for option holders. But I think that as we usually see, weeks 3 and especially 4 are going to be good for option holders, especially if the market volatility comes in a bit. So that's kind of the overall look I have at it, Mark.
And Mr. Mike, I know you're not a big earnings watcher, but even you hear the persistent drumbeat coming into the start of the year that, hey, earnings are going to really derail this market. They're going to be apocalyptic. And so far, through 2 cycles, that has not been the case. Or have you been surprised at maybe the resiliency we're seeing from some of these names that have been reporting? And then what are you looking forward to or maybe dreading coming up from the next round of earnings, sir?
I can't say I'm really surprised, just because of the fact that on Main Street, or at least in Main Street, St. Charles, I should say, people are spending money, and I see people out. I see people in restaurants. It's always a long wait to go to any restaurant. And it's always a long line if you want to get groceries or go to the Home Depot or whatever. So people are spending money. And the question becomes, what money are they spending? Are we going to come home to roost pretty soon, as Matt says, or is the economy really that good, and are people going to continue to do well? But from the standpoint of, am I surprised? No, I'm not, because of just seeing people out like they are. Now, what's scaring me? Well, a lot of things scare me. I'm afraid of clowns. No, just kidding. But in terms of some of the earnings that would scare me, what does scare me is the fact that all those people that you see out right now, are they just habitual spenders that are spending money that they don't have anymore? So, for example, during COVID, when all the free money was out there, so to speak, and people are going and stimulating the economy by spending money and in turn causing inflation, it was their money because it was given to them a lot of times. However, when you get in the habit of buying those extra groceries, of buying that extra clothes, or whatever the case may be, it's hard to break habits, especially when habits feel good. That's why we have smokers in our society, apparently. But my point is that what I am fearful of would be on more of a macro level is, are we going to be broke again as a society? Meaning, are all of the consumers going to spend all the money that they had? And has this economic stimulus that we had a couple years ago, has that created poor saving habits? And if it has, that does scare me. But with that being said, we do live in America, and America will come through, I believe.
And you know what else comes through all the time, listeners? It's your mail. Let's get to it now. A little bit of the old office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right. Welcome to the Office Hours, listeners, a portion of the show where you folks take the reins with your questions. This episode's question comes from Andrew. Sounds like he maybe is a budding advisor. He wants to know which exam offers the best preparation for options trading, Series 7, 63, CTA, or something else. My short answer to this, Andrew, is none of them. They all suck when it comes to options preparation. I've yet to hear of an exam that really goes deep into the world of options. In fact, that's why our friends on this show, the OIC, a few years back, they really tried to make a play at some sort of options certification exam. And the exchanges and others pushed back, really post-Madoff. That's what killed that, because no one wanted to certify someone as an options-oriented advisor who then goes out and blows everyone out with some high-risk strategy. So you can blame another thing on Madoff, and that is the lack of any sort of real specific options certification or exam. They had a few one-day courses. You could have a little bit of a shingle you could hang on your wall from those, but right now there really is no options-centric exam. That said, I have not taken any of these, so I will open up the floor to Uncle Mike and Mr. Matt, who have taken at least several of these each. Maybe we'll start with you, Mr. Mike, as our guest, sir. He wants to know, which of these do you feel prepares him the best for options trading? Some of these ones he lays down, or perhaps something else, sir?
Well, so throughout my career, at one point, I have held the Series 3, the Series 4, the Series 6, the Series 7, the Series 63, the Series 65, and all 4 insurance licenses. The only ones that I have now are the Series 65. I've dropped all the other ones. I do still have my insurance license. I don't really do a lot with it, but I do still have it. And the reason is that, number one, the Series 7 back in the day was pretty heavy in options, probably about maybe 40% of it. But I don't feel that what I learned from that test or the studying of it made me a better option trader, or had more knowledge, or had more. I don't ever recall it working, and keep in mind, this is 15, 20 years ago that I took it. I don't recall it saying, well, how would volatility affect this? And how about this, that, or the other? It was all it was a lot of basic questions to where at the time I was just a trader. I traded options myself. So I aced it and it was very easy for me, but it didn't really help very much. And if you do trade options somewhat frequently, it wouldn't really help you either. And now, from my understanding of the Series 7, they don't really have, it's not near as option-centric on there. And on top of that, you're going to have to get registered as a broker as opposed to an advisor. So I guess it just kind of depends on where you're going with it. My short answer is that those tests really aren't designed to help you become a better option trader or option expert. So I would focus on, how do you want to charge people? How do you want to make money? That type of thing. Determine your licensing that way. And if you're looking for a certification, I don't know of one. Whenever I tell people about my option trading expertise, I tell them it's Real World 101, and I'm a host on the Option Block. So that's how I do it. So I really don't know of a certification that gives you that.
Yeah, again, blame Bernie for that one. Mr. Matt, anything you want to add there for our listener, Andrew, who wants to know which of these, if any, prepares him the best for options trading?
Yeah, I went to graduate school heavy on finance. I have a CPA, CFA. I'm a registered investment advisor. They don't do anything for that, but I wouldn't look at testing. The most I learned was just from trading myself, and then a lot of these market maker, they had classes, so I had to teach my market makers that I backed. But Group 1 had a good one. So Andrew and those guys at Option Pit, they're doing a lot. And there's some good books out there. Trading Volatility by Colin Bennett, I thought was pretty good. But there's a lot of there's some decent YouTube videos to watch. But a mentor is great. And then just start trading small. Look at a lot of back tests. Get a lot of good data. Try to find your niche. That's what I'd say, Mark.
All right, listeners, that music means we have come to the end of yet another episode of The Advisor's Option. Funny how an hour flies by when you're having fun, listeners. But before we go, Mr. TOSAW, sir, if folks are intrigued, maybe they're an advisor, they want to reach out to you with some questions on how they could utilize the wheel or something else we discussed on the show today, or maybe on the flip side, maybe they are a client looking for an advisor and they want more information on what you're bringing to the table. Where should they go? What should they do?
Well, feel free to visit my website, stcharleswealth.com. My niche, so to speak, is option volatility as part of the portfolio. I'm also an enrolled agent, so I do tax planning for my clients as well. Feel free to follow me on Twitter at Mike TOSAW. And if you are another advisor and you're looking for someone to trade covered calls for your clients, we do have our SMA programs that we have as well. So just reach out to me, stcharleswealth.com.
And Mr. Matt, while you're busy powering down Otto, I'm glad to see you survived the episode, sir. If folks want to learn more what you have cooking over there in the land of ORATs, where should they go? What should they do?
Oh, that's interesting. I didn't know that Mike did cover calls for SMA for other advisors. That's cool. I get asked that sometimes. So come on over to ORATs to see our stuff, including that 150,000 wheel back tests, and we're going to get to 1 billion back tests for everything else. So you could go on. It's really cool. It's too much to get into. We have a new market intelligence tab. Mark, you might have got that email we blasted out to our users that we have trade ideas for this in particular environment. We define the environment. So come on over to ORATs. Matt at ORATs is my email. And we're getting a few people from the Option Insider Radio. So thanks for that, Mark, and see everyone over at ORATs.
Glad to hear it. Check them out over there, orats.com. Maybe Otto will still be lurking by the time you head on over there. You can maybe ask some questions for Otto as well. Of course, a lot of great back tests, including many on the wheel, which is one of the reasons why we really decided to take a deep dive at the wheel. Again, if you have questions, you know where to find us, listeners. Speaking of questions, coming up in a little bit for all you pro folks who are hanging out in the live, I'll be back in a little less than half an hour now with our buddy Mr. Jim Carroll, formerly from TOSAW Advisors. You know him, you love him on Twitter as @Vixologist. Going to be tackling a lot of your vol questions, and I'm sure, given everything going on out there in the vol landscape, you probably have a few of them. So if you're listening live on the pro side, get those questions in if you haven't gotten them in ahead of time already. Of course, if you haven't joined us on the pro and you have a lot of questions, and who doesn't these days, only one place to go. TheOptionsInsider.com/pro is the place to go to learn more. Once you click join on that link there, you'll have access to your own exclusive podcast feed with 250, I think, episodes waiting for you the second you hit that button, plus all sorts of other fun benefits. TheOptionsInsider.com/pro. We have to get on out of here. Back again in a little bit with another great pro Q&A session, and then back again next month, another episode of The Advisor's Option. Stay safe out there, everybody.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.